One of the most important options trading strategies is the covered call. The covered call is great, especially if you're new to options trading, because when you're new to options trading, you're not necessarily new to trading in general. Most people have already been trading stock. Most traders have a long portfolio of stock, and if you already have some existing shares, it's very easy when you get into options to just start selling calls against your existing shares of stock. And on top of that, covered calls actually reduce your overall risk on those shares of stock. Option strategies explained. Today we're talking about covered calls, but first I do briefly want to talk about naked short calls, because selling a naked or an uncovered call is dangerous. It comes with unlimited risk, because with short naked calls you have unlimited risk to the upside. If the stock explodes in price, you could potentially lose thousands of dollars, tens of thousands of dollars. You could actually blow up your entire trading account. Because of this, many traders don't like ever selling naked short calls. Some traders just refuse to ever sell naked short calls. They just don't do it. And that's because of that unlimited risk you have to the upside. But one way to define your risk is by covering that call. What this means is that you also purchase the underlying stock position to cover any possible assignment should that call go against you. And if you have 100 long shares of stock and also sell a call at the same time, this is what we call a covered call. Again, the covered call is a very popular strategy among options traders. It's often one of the first strategies, if not the first strategy, new options traders learn. The covered call also plays a major role in the wheel option strategy, which is my favorite option strategy. The covered call is the back half of the wheel. Remember, the first half of the wheel is selling cash secured puts until you get long shares of stock. And then once you have those long shares of stock, you proceed to the back half of the wheel, which is selling calls against your long shares of stock, essentially the covered call. If I go to this slide here, I've shown this slide in previous videos, but this demonstrates the wheel strategy. You sell cash secured puts over and over again, until you finally get assigned 100 shares per contract of long stock. And then once you have the long stock, you proceed to the back half of the wheel where you start selling covered calls over and over again until you're finally assigned on the call. And then when you're assigned on a call, of course, you have to short stock, but you already have the long stock anyway. So essentially your long shares of stock get taken away from you. And then you begin the wheel again by selling cash secured puts. So here is an illustration of the risk profile on a covered call. So a covered call, again, it's a combination of a short call while at the same time holding 100 shares of long stock. And this makes this a bullish strategy. And this is something especially new options traders sometimes get confused about. They think the covered call is more of a neutral strategy or even a bearish strategy, and sometimes they get upset when the stock price actually goes up and their call gets assigned and they lose their shares of stock. Well, this is what you want, because how do you make the most amount of money on a covered call? Well, the most amount of money is this thing actually reaching this point, blowing past your call option, the call strike, and getting assigned. So never fear assignment with a covered call. Assignment with a covered call is actually a good thing. Now, when it comes to the reward on a covered call, the max reward is your credit received for selling that call, plus the difference between the call strike and whatever your cost basis on the shares that you purchase. So if you purchase 100 shares of stock at $100 per share, right? So 100, and then maybe you sell a call option at the 105 strike. So what's your max reward? Well, your max reward is the difference of the strikes, right? So that would be $5. So your max reward is $500 plus whatever premium you got on top of that for selling the call. Let's say you sold the call for $1. So your max reward in this case would be $6. When it comes to the max loss, well, your max loss, unfortunately, is unlimited to the downside because you do own these shares of stock, and the company could go all the way to zero. And if that happens, then obviously you lose everything. Whatever value of that stock you have, you could potentially lose that entire amount of money if the stock just plummeted all the way to zero, which means the company essentially went bankrupt. Now, that's probably an unlikely event, but it can and sometimes does happen, especially if you trade really bad companies, garbage companies, questionable kinds of companies. I wouldn't trade covered calls on weird, like penny stocks, things like that. Sell covered calls on legit companies. For one thing, if you're owning shares of any stock, it really should be a company that you want to hold for the long term. So again, don't sell covered calls on just anything and everything. When it comes to volatility, you would prefer to sell covered calls when IVR is high, and the reason for this is anytime you sell options, you want high IVR. That way the premiums are richer, and you want rich premiums when you're selling an option. Now in practice, you're typically not going to focus that much on IVR with covered calls because rarely are you going and looking at various underlying stocks, potential trades to put on covered calls. Typically, when you're in a covered call, you're in it because maybe you were already running the wheel strategy. So you really have no control on what the IVR of that stock is at that point because you were assigned shares of stock. And at that point, you're just going to start selling calls against it, regardless of what the IVR is. Or you already have a long portfolio of stock. Maybe you're a long-term buy and hold kind of investor. You've already got long shares of something like SPY, for example. And whether IVR is high or not, if you want a little extra income, sell some calls against those shares of SPY. You can't just sit around and wait for the day that IVR spikes and becomes high. If you do that, then you're rarely going to be selling covered calls, unfortunately. So even though you would like high IVR, it's not something that's that important. If you already have shares of stock, go ahead, start selling those calls right away. So let's talk about managing your covered calls. The first thing you need to do is determine your cost per share on the stock that you now own. So if you have 100 shares of ABC stock and you're selling a covered call against it, remember, whatever premium you receive for that call, that reduces your overall cost per share, your overall cost basis for those shares. And keep track of that. Every time you sell a cash secured put when running the wheel, and every time you sell a covered call while running the wheel, you receive credits. And each of those credits that you receive lowers your cost per share. It lowers your cost basis. And you need to know what your cost basis is so that way you know, hey, I can either get out of this thing right now for a break even or a small profit, or right now I'm still a little underwater. I need to keep selling these puts, selling these calls to eventually get that cost per share down low enough to where I eventually, hopefully, get out of this trade for a profit. So an example, let's imagine that you get assigned 100 shares of ABC stock at $70 per share. You were running the wheel, you were selling puts, and eventually your put got assigned and you were assigned at $70. But let's also say that you received $350 from selling puts along the way. So is your cost basis $70? No, your cost basis is actually $66.50 because you have to subtract that $350 in premium that you receive from selling puts. And that, again, that lowers your overall cost basis. So if you got assigned at 70 and your cost basis is now $66.50, well, let's imagine also that ABC stock is also currently trading at $68.25 as of today. That actually means you could just sell those shares right now for a small profit, right? You can actually sell your shares and start selling cash secured puts again if you want to restart the wheel, or you could keep the shares and just continue to sell covered calls if you actually prefer to stick with the back half of the wheel and keep doing covered calls. Really, at that point, it's kind of up to you which one you do, because either way, you're doing well in the trade. And of course, all of this determining your cost basis, we're talking about if you were running the wheel and adding up all the credits. Obviously, if you just open a brand new position starting with a covered call, then calculating your cost basis is really simple. It's whatever share price you just bought those shares at minus that call that you just sold. So again, and this is not difficult to keep track of. Hopefully your trading platform is smart enough to help you keep track of your cost per share. So let's talk about a bit of a controversial subject. Let's talk about selling calls below your cost basis, because you're going to get different answers to this question depending on who you ask. But should you ever sell a call below your cost basis? Generally speaking, it's not wise to sell calls below your cost basis, because obviously if that call gets assigned, you have to sell those shares at that call strike, which is below your cost basis. Essentially, you're locking in a loss on the trade at that point. So obviously, no one wants to sell a call below their cost basis, right? Of course, right? But sometimes you have no choice but to sell calls below your cost basis because the underlying stock has dropped so much in price, right? It's dropped greatly in price that you can no longer sell calls above your cost basis because those calls don't exist, or those calls are just really, really cheap where you'd only be receiving a few pennies in premium, which is not worth it at that point, right? To actually get some decent premium, you have to start selling calls closer to the underlying stock price, which now, again, that underlying stock price has fallen so much. Now those calls you're selling to get a decent premium, they're below your cost basis. So should you do that or not? Well, there are two schools of thought on this, and they generally fall into these two camps. The first camp is people will tell you just hold the shares and pray for a rebound, right? If you can't sell a call above your cost basis, don't ever sell a call again until the price rebounds, right? You just hold the shares, you just hold and hope, right? You pray for a rebound, and hopefully that rebound happens. If it does, then eventually the share price will come up enough to where potentially you can sell the shares at break even or even for a small gain, or the shares come up in price enough to where you can eventually start selling calls again. The second school of thought on this is just go ahead and sell calls anyway. Even if it's below your cost basis, it's not worth it just to sit on your shares of stock and hope that the stock rebounds. Who's to say that stock will ever rebound? It may not, right? You don't know. You never know on these things. But at least you can start selling some calls, even if it's below your cost basis. Start selling some calls. Start collecting some premium. Every little bit of premium you get reduces your overall cost basis. And who knows, selling those calls below your cost basis may eventually get your cost basis low enough to where you can eventually start selling calls that are above your cost basis again. And that's really my advice. Is I like number two here. I like the second option. My advice is don't be afraid to realize a loss on a covered call. So if you have to sell a call below your cost basis, do it. Because I'm never just going to sit on shares of stock. I don't like that. I'm an options trader. I never want to just be holding long shares of stock without doing something else alongside it. Also, I'm not one of these people that refuse to take a loss to realize a loss. And some traders, especially new traders, they think it's some kind of badge of honor to never accept a loss. I'm never going to realize this loss. I'm just going to hold on to these shares forever. I may average down. I may buy more shares. I may do all kinds of crazy, risky things, but I'm never going to just accept a loss and realize a loss. That's a horrible way to do trading, right? Sometimes you just need to realize a loss. So, I'm fine selling calls below my cost basis because it's never about one trade. Realizing a loss on one trade, it's not about that one trade. That one trade doesn't matter. Think about all the future trades you're eventually going to make in that same underlying stock, right? It's not about one trade. It's about the hundreds or thousands of trades you make over your lifetime in that stock. Quit focusing on what happens in the one trade, because trust me, you're going to have plenty of chances to recoup that loss. And I can actually give you guys a great example of me doing exactly what I'm talking about, selling calls below my cost basis, because I've been doing this for several weeks, maybe a couple of months now, in a particular underlying that I've been kind of stuck in for a while. You guys see I have this ARM position. ARM, ARM is the ticker symbol. You can see right now I've got 200 long shares of stock. I'm selling two calls at the 128 strike, which is a little below my cost basis. You can see the cost basis on the shares is at 131, but honestly, the 128 is probably at my break even or maybe even above, but I've been trading a lot of calls on these shares of stock for a while. You can see overall I am down on the position $3,300. That's a pretty big loss. Well, what if I told you I was down $6,500 on the position? I was down $6,500 on that 200 shares of ARM stock, and I've recouped half of that loss back. How did I do that? By selling calls. I have sold a ton of calls to get that loss back. I've just been churning calls. Let me go to the chains here, the options chains here on Tasty. Let me move my head out of the way so you guys can see this. And by default, it defaults to a 30-day time period. So these are all the options I have sold in the last 30 days on ARM. And they're all calls. They're all short calls. And I have made $705 in premium in the last 30 days just selling calls against that losing position. And most of these calls were below my cost basis, especially at the time I sold them. So that's, that's quite a bit of money I've made in 1 month just churning some calls. It looks like I made 10 trades. So I sold like 10 different calls positions in 1 month. And if I go back 60 days, look at 2 months, I think I'd made like something like $1,800, $2,000 in the last 2 months just from selling calls on that arm position that, again, I was down like $6,500 on at one point. And, you know, that first school of thought would say, hey, if you can't sell calls below your cost basis, just don't do it. Well, if I had done that, I wouldn't have made that $2,000 or so in call premium that I made in the last month to help offset those losses. So yeah, I'm not a big fan of just the hold and hope, right? I'm not a fan of just sitting on a losing stock position and hope it rebounds without trying to actively do something to help it. So that is my thoughts on the covered call strategy, one of the most popular options trading strategies out there. Again, it's typically one of the first strategies a new options trader learns, but you don't have to be a new options trader to use the covered call. Even experienced options traders love the covered call. If you want to learn more about options trading, especially my favorite option strategy, which is the wheel strategy, check out my book, The Super Wheel Option Strategy, available on Amazon. You'll find a link to my book in the description below. Peace, guys.